Hi, I'm Matt Balderston, Certified Financial Planner with Pure Financial Advisors, and this is the Question of the Week. Now, I have a lot of clients with kids in their 20s and 30s, and so I get asked all the time, what's some good advice I can give my kids about getting started with investing? Well, the first thing that you really want to tell them is ultimately that, get started. You know, we make excuses through our whole lives about why we can't afford to save. But a lot of times you look back 20, 30 years later and realize you haven't made any progress. So it's critical to build those habits young and start early. Good example of that is if, let's say you take a 20-year-old that starts saving $1,000 a year and does that for 10 years and then stops. Then you've got a 30-year-old that starts saving $1,000 a year and they keep saving indefinitely. Well, as long as they're invested in the same thing and they're getting at least 7.2% rate of return, the 30-year-old will never catch the 20-year-old because of that head start, even though the 20-year-old isn't investing anymore. Now, I don't recommend stopping, but for that example, I think it makes a good sense. So ultimately, you want to get started. The second thing you want to do is once you have started is make sure that you increase your savings little by little. When you're young, you can't save that much, and if you stick at that level, that may not work out long term. So when you get a raise, add 1% to your 401k contribution or add $25 a month to wherever you're investing outside. And that $1,000 a year you might be starting with, by the time you're 30, might be $1,000 a month. And since it was done incrementally, you may not even notice that you were doing it. Finally, I mentioned a 7.2% rate of return in my first example. If you're going to try to target something like that or better, you definitely have to get some of your money in the stock market. So tell your kids not to be afraid of it. You hear the comment all the time about beating the market. It sounds like it's an opponent or something you want to compete with, but it's not. It's actually your best ally toward building long-term wealth. So team up with it. Let it take you where it's going, and you'll likely do a lot better than the average person. It's going to go up and down a lot in the meantime, but think about it like a roller coaster. If you get on and then when you're done you get mad because it went up and down too much, you just didn't understand the ride. So with the stock market, just let it take you where it's going to go and you'll do great. So that's all I have. If you have other questions on topics like the types of accounts to invest in or tax implications of those accounts, check out some of our other blogs. But otherwise, that's it for me. I'm Matt Balderston, and this has been the Question of the Week.